Hey, it's Todd Flavio, Pacific Residential Partners. So it's March, and this is our interest rate outlook for the month of March. So we're going to suggest a float, and our confidence score has gone down to 5, and that certainly is a change from February. So, let's look at February. I was certainly off the mark, as a lot of people were. We've been pretty consistent and accurate with most of the updates, but February is not a good month. There was some additional data that came in that was a bit of a spike in inflation, and it caused a lot of concern and a lot of caution. And the net result was the anticipation that interest rates would not quite decrease or lack the increases as rapidly as everybody expected. So that certainly changed things quite a bit. This goes back to the criticism of the Federal Reserve. And the criticism has always been that they're looking at data that is already occurred, and in some cases is 90 days old. And I think that's really what happened here, where February data was really a result of indications and changes that occurred back in maybe November, and it wasn't quite accurate as to what's occurring now. And the Federal Reserve, again, they're not really looking at forward-thinking data or data that's occurring right now, because all these monetary changes take time to really have impact. And when things happen quickly and there's sharp increases in short-term interest rates, it takes a little while for those to kind of sort out. We certainly missed it a little bit. We've got rates that have gone up, but there's an important date that is coming up, and that is May 10th. And May 10th is a really important date because that is when the year-over-year data for inflation and some other economic readings are going to be adjusted. And what's going to happen is a lot of those readings that occurred a year ago are going to start to drop. We're going to see economic data that supports the fact that inflation is decreasing, and that's based on all the readings that we've seen over the previous 9 months. So that is going to be an important date. And what that really means is after May 10th, we're going to see rates really start to come down a little bit quicker maybe than we've seen since last year. So May 10th is an important date. So what happens until May 10th? Well, we're going to have a lot more of what we just had. We're going to have a lot of volatility. We're going to have a lot of people and economic reports and experts trying to analyze the data. It could be conflicting, which means we're going to see a lot of volatility, and we may see rates possibly retest the high that we see now. So again, we're at 7% in some cases, and we may see rates go up a little bit higher. So what does this really mean for the next 60 days? Because we think in May we're going to start that decrease that we've been hoping for. I don't think it matters. And I think over the next 60 days, whether the rates are in the 6s or in the 7s, it's going to be painful for everybody if you're a buyer or if you're an advisor. But I think it doesn't matter, because what we're going to see is by the end of the year, we're going to see rates back into the 4%, 5% range, which means it doesn't matter what your rate is, because you'll have lots of opportunities to move into a lower rate at no cost or minimal cost. So keep that in mind. Again, I'll continue to mention May 10th and why that's so important. And always love your comments and your feedback and any suggestions you have. Remember to follow us on all of our social media channels. Look forward to connecting with you soon.